and formally welcome y'all to our special topics discussion this month on investor accounting basics with She's Independent and our special guest, Ernie at Accountability Services. We're going to get into a bio shortly. But I just want to welcome everyone and, listen, I'm wearing mascara. We're talking about accounting. Like, this is an exciting topic. Anyone who knows me these days, like, I'm not usually wearing makeup. So the fact that, I'm not in full sweatsuit, this is a big deal. I don't know if y'all are excited, Kristen. I see your smile. I see your head bob. When you're an investor, right? Like we recognize this stuff really matters and it allows us to really up level how we show up, how we think, how we allocate, how we plan. Ernie's going to get into that with us. Thank you again for being here. This session's recorded. So if you are like, what did they say? And oops, I didn't ask, but I want to revisit that. We are going to share that with our member community and also on our YouTube. And we're also going to have another session that dives into some more strategic conversation on everything accounting. February 18th, we're going to get that on the schedule and on our Luma. So let me just move over to kind of bios quickly. I'm Natalie Levy, the founder and managing partner at She's Independent. We are an angel investment group really leaning into access, education, women, recognizing the gaps that exist in the financial world and ecosystem today. So we're really excited to show up in this way, to allocate capital in this way that's really impactful, and to partner with amazing folks like Ernie and team to do what we do. And I'm an investor by background. I've been on Wall Street, I've been in private equity. I have an angel portfolio that's about 45 strong. Gosh, Ernie and I, who've now been working together for years, he knows I have some complex situations, but guess what? We work together, we partner. He and his team are awesome, and we're really excited to today formally actually showcase some of the work and some of the insight that he brings and in terms of like how we operate as an investment group at She's Independent. So I'm going to pass the baton to Ernie, but I will quickly say before that, we syndicate at She's Independent. We run our own deals. We do this from a cost standpoint. We said, hey, we want to learn. We want to make things, really investor friendly and price accessible. And we can do that because we have an amazing partner like Ernie and Accountability Services. So with that, Ernie, why don't I hand it to you if you want to give a brief, maybe 1 minute intro on you, and then we'll get into the discussion for today.
Absolutely. Thank you, Natalie. You know already it's a lot of fun to join you here today and to get to meet some folks. My name's Ernie Villany. I'm a CPA. I practice out of Boulder County, Colorado, with the company Accountability Services. We are a small but national firm, mostly out of the Front Range and Seattle area. My title is Chief Advisory Officer, and that's just a way of saying that I have the privilege of getting really great data from our accounting team, which we refer to as Client Accounting Services, and our tax team. And I get to use that information to work with business owners of all size and types, investors in things like what She's Independent pursues, but also people who have ordinary trade and service-based businesses and rental real estate and things of that nature. Ultimately, accountability services is just a little bit different because we're just not historians. We are people who work with people who want to scale and grow and scale and exit. And they want to work with people who can help them, at the very least, predict what they're trying to do with their businesses and their investments. And when things go really well, prescribe an outcome that they're looking for. We are very data driven. We rest everything we do basically on relevant and reliable financial statements, which turns all of our activities with clients into a planning session, not waiting for some shoe to drop or some unexpected event to occur. Now it's too late. We're very proactive, to coin a very familiar term.
And efficient, I want to say. Meaning, I've seen some new things you've rolled out. Anyway, we'll get into this. So thank you for being here, Ernie. I want to also make a statement, and we say this when we're workshopping, at She's Independent. This is truly a space of belonging and access. All questions are welcome. Like if we say something and you're like, what was that? You can type in the chat. We also invite you to come off mute. We will have some time for Q&A, later on. But if we say something and you're like, wait, I want to know now, feel free to chime in. So with that, let's jump in and talk about it. This is this first conversation for, this group who's joined us today to dive into these topics in more detail. At She's Independent, we have a lot of investors that are stepping into venture investing, angel investing for maybe the first time, or maybe, really starting to step up their portfolio. So the first piece we're going to kind of jump into, or I guess to set the stage a little bit, in your intro, you talked about, well, what's important and how do you think about planning? But what are people going to get out of, I guess, today's session? When they step out of the room today, Ernie, like, how are they going to feel equipped, or like, what are things that they're going to feel, going into their day or their schedule and saying, wait, now I need to prioritize this, or I need to rethink things. So maybe just to set the stage a little bit more, expectation for today.
Right. So this is a very functional conversation, specifically around reporting and specifically around K1s that partners in a partnership get. There's a variety of different K1s, but for our purposes today, we're focusing on the form and function, timing expectations, deadlines, things that are considered milestones that partners should consider investor needs when looking for an accounting partner. And then, really, at the end, we're just going to get into a wide variety of topics that almost anybody who's in an investment, whether it be what She's Independent pursues, or rental real estate, or their own business. So, lots of form, lots of function, lots of things that people can walk away with and walk into a conversation with another advisor, another tax professional, and be empowered and educated and well informed about what they're talking about.
Yeah, and make sure that the person they are working with is also informed. I've literally, and I've shared this openly and transparently, like the reason I'm working with Ernie's team, the prior team I was working with, like was dropping the ball. They didn't have the strategy, they didn't have the framework. And so making sure you also navigate to a relationship that you trust and, someone that can offer, strategy throughout. So K1s, aka partnership returns. Let's talk about them. Ernie, you just mentioned there are different types. Maybe walk us through, what are K1s? What are they used for? What's in a K1? And let's have a focus on venture investing, but maybe also mention real estate investing, like partnership there, just recognizing I know a lot of folks in the group also have some real estate interest, but let's focus on the angel and the angel portfolio.
Perfect. So, if people don't know already, K1 is a tax form, right, that comes from the IRS and is, in its simplest terms, it's a report that tells the partner their share of income, losses if that were to take place, the deductions that they're eligible for in this setting, credits, specifically state credits that have passed through some of the She's Independent syndicates. And it's used to complete your individual tax return, right? Effectively passing all of the partnership's results to the partner. So in a syndicate setting, that would typically be potentially interest, dividends, or capital gains. As you switch to other areas like rental real estate profits and losses, and for businesses, ordinary income. So, really, in a nutshell, it's a tax form coming from the partnership to the partner that makes it very plug and play for them to do their own personal tax prep.
Great. And sometimes giving actual examples will be helpful, I know, and I know it always is for me. So I'll give you the example that I've had K1s around partnership interest in both She's Independent syndicates. I've had K1s around direct checks, or not direct checks, I should say. A check is kind of an LP into a fund, so a private equity fund. I had a K1s around that. And also external syndicates, external to She's Independent, where I was one of, many investors. So those are examples of K1s that I've received. And then Ernie and I are going to talk about, because I now have a partnership with a real estate interest. Kristen, you can smile because I know you know all about this area of things. And that's another K1 that we're also going to explore this year. So at a high level, those are the K1s. And by the way, we can talk about the She's Independent K1s if people have questions. we're going to get into a lot more detail here. So, um, that's all helpful. Let's talk about, I guess, um, we talked about planning. We talked about, okay, what are the expectations? Um, Maybe first let's talk about timeline, right? I'm an individual investor. I'm expecting to get K-1s from the partnership so then I can report to the IRS or my accounting team can do this. And I need to supply that to the accounting team. But talk to me about expectations. What are the deadlines? What should I be thinking? Do I need to think about an extension?
And Natalie, it really just touches quickly on the value of what you're doing here today,
Yeah,
right? For people in this room. This is a fear-fueled experience for a lot of people. Tax forms in general, right, is a phobia that people experience. And when they're getting these K1s for the first time, or they've just had a negative experience around getting a K1, there can be a lot of PTSD for that is there for them, and rightfully so, right? They didn't really participate in the preparation of that document. They know they have to receive it, and they know that they either have to do something with it themselves or pass it to another tax professional who also does not have a connection to the partnership or may not
yeah,
have, right? So you're just doing one of the most important things, right? Is empowering people and eliminating fear that they have around these things. So
yeah,
functionally, by March 15th, the partnership must file its partnership tax return, meaning that that's the very latest without an extension of time to file that they have to get that form to a partner. The fear kicks in when the partner says, "Well, why is the partnership going on extension? That sounds like a bad thing to me." Generally speaking, it's not a bad thing, or inherently it's not a bad thing, but it can point to some things that are going on within the partnership that these things are not getting done in the normal time horizons. So that's where we focus on workflow and communication, and the most important thing, getting those financial statements done in a
yeah.
timely basis, which means as close to December 31st as possible, typically in the first month in January, and getting those tax forms to investors at least 30 days, if not preferably 60 days prior to a conversation with their tax preparer who's focused on an April 15th due date for their personal taxes.
Yeah, and I want to add in because I think the context is really helpful here. She's independent. When we run syndications, these are very kind of light lift in terms of course, there's expenses and we're reporting and we're working with the accounting team, but there's not a ton of cash flow activity happening. And so these are pretty simple K1s to prepare at the end of the day. We're not requiring extension, you to file extension. However, if you're an LP in a fund and there's, really complex cash flows and there's a lot more happening at the fund level. Um, I'm basically always requiring extension, for the K1s that are coming from the private equity fund. So recognizing also the shape or the timeline is going to be dictated by the partnership and typically the complexity, but maybe also the way that they're able to either work proactively or maybe they're more reactive, but just something to keep in mind.
You've also been really instrumental in this kind of education and awareness part, Natalie, because we did a lot of hard work, even with legal counsel, to show that when there is no activity, right, after year one, and that K1 is going to have a big old zero on it,
Yeah.
there's no pressure for that investor or that partner in a partnership or member in that LLC to be expecting that K1, nor
Yes.
should they. It's not
It's a
coming.
great, it's a great point. And US tax law changed the other year. You used to have to report K1s or, deliver K1s, even if there was no cash flow activity, and that changed. So brilliantly, and thank you for, stating that because it honestly is one of these really nice things as an investor with a lot of private investments. Again, to repeat that more slowly, if there's no cash flow activity after the first year, and there's other stipulations too, but you're probably not going to need a K1. And we'll talk about the situations in which you need a K1. But I guess to state it another way, you're going to get a K1 the first year, right? And then we'll talk about the other events that might trigger one. But if there's no cash flow activity and no material change, you don't expect a K1 after that first year of investing.
Indeed.
Great. And, maybe let's talk about here, other topics, that matter for K1s. What is an actual K1? We said, it's a partnership return, and what kind of information, is the investor providing? What kind of information or, what does the K1 look like? Recognizing we have different investor types. Some of our investors are investing as an individual. So Anand may say, hey, here's my individual, information. Kristen may say, you know what? I have an investment entity. Maybe Preeti says, I have, actually a trust that I'm investing. Or Tracy says, I'm investing on behalf of, I'm investing with my IRA. So what does this look like in practice? What's expected in terms of the information, the tax identifier? Yeah.
So I'll move quickly through, excuse me, some of the easy stuff,
Okay.
right? The K1 is going to have the partnership name EIN on it clearly. It's also going to have very neatly, box by box, ordinary income, interest, dividends, capital gains, distributions, credits, all that good stuff. But for today's discussion, I've really kind of honed in on critical data for the partner. And on the K1, in part two, it's titled Information About the Partner. And the critical data in there comes in two forms. Primarily, when the partnership files its initial return, that's my focus in this moment, because that becomes this very important historical document for the partner. It establishes who you are, right, in the eyes of the government and the eyes of the partnership on a reporting and compliance level, and specifically partner social security number if they are an investor, an individual. Is it a tax ID number? If they're anything but an individual, the address is understood. The distinction between am I a general partner and a limited partner? For our purposes, nobody in this call is a general partner. But since we've expanded this a little bit about rental real estate and ordinary trade and business, you can have people who actively participate and run the partnership, and you can have people who just invest. The one where it starts to get a little bit confusing for others and is really a key point in getting your K1 early from the partnership. Partner types are individuals, LLC members, disregarded entities. Before I go further, in many people's minds, those are the same things. I'm an individual, but I own an LLC. It's a single member LLC, so it's disregarded. What's the difference? There are definitely differences, and the value of those differences may have been established by your personal tax representative. So giving them the draft of that K1 early gives them that really good space to review part two, the information about the partnership, because it gets even more complicated. Some people are investing through an IRA, a SEP, or even an old KEO, right? They might also be investing through a trust or an exempt organization. They may even not be a US taxpayer. So, part two is a story that's told. It's a story about the relationship that the partner has with the partnership, and it's a story of numbers. The numbers are the beginning and ending percentages of the partner share of profit, loss, and capital. And when you're talking about that initial return, that first K1 that you're going to get right in this investment experience, those numbers are critical to make sure that they have been heard and reported and shared back with you correctly. Its close connection to that is the beginning and ending dollar amounts of any liabilities that you may have. In this setting, that number is zero, right? In rental real estate, there could be an underlying mortgage that the investors have made through the partnership. That's a really classic example of a liability that a partner in a partnership might have a connection to. And this is, in my mind, the last one and definitely the most important, the partner's capital account analysis. It is a critical component of understanding your beginning capital, which generally speaking, in an investment is going to be zero. It's going to show the capital you contributed, right, during the year. And to a lesser degree, and I won't go into it, withdrawals that are made, income that is allocated to you, deductions that are allocated to you, and the results that get you to your ending capital. If this is not established thoroughly, right, and accurate, right, to the dollar from the starting point, the partner in a partnership is in a position of weakness, and there could be lots of things that need to be amended and cleaned up. And so, as a starting point, it's a moment to reflect and really check in on accuracy.
Yeah. And just to reiterate, like we work with Ernie and his team, so you all don't have to worry about like all these numbers. We're preparing these. Ernie's team is working with us, and so we're going to give you that K1 and say, "Great. Here's the K1 and it states these things, the ownership and all these other pieces and data points that Ernie is speaking to." It's our job to make sure we have accurate information from you and also your job to make sure you're getting it to us so that we can properly identify you and all of that legally, but we're giving you the K1 and so he's basically describing what is going to be in that really pertinent documentation. Um,
Indeed.
and this kind of brings up for me because you talked about, for example, beginning and ending percentages of ownership, and you use different words for that, but we have an example of a follow-on investment, meaning a reinvestment that we're writing another check into a business that we really enjoyed and we've seen great traction with. They're called Bone Health Technologies or OsteoBoost. So that's an example where we already had initial K1s prepared, but now we're going to reinvest, and then we're going to have to restate K1s. Actually, sorry, that's going to be a 2026 reinvestment. 2025, we did a follow-on in a company called Tint, Tynt. So that will be changing the ownership percentages because folks are either reallocating or maybe allocating that weren't participating before. So the percentage ownerships change. I hope I'm saying that in a way that's clear, but basically an example of where She's Independent is investing in a company a second time. It's called a follow-on, and then we're going to be restating those K1s.
I know this is the Ernie and Natalie Mutual Admiration Society, but it really is worth mentioning that these circumstances or events that you just discussed are largely not discussed in advance.
Yeah,
It usually comes at the consternation of an investor who got a K1 that those percentages and dollar amounts look different.
yeah,
They're not even aware of it, but it's their CPA or tax preparer looks at them, holds it up, and goes, "Were you aware that these percentages changed from the
yeah.
beginning to the end?" And the fact that you lead with this and you ask us, right, to create these education and empowerment opportunities is so much better long term for the
Yeah.
partners and the partnership.
Well,
And
at some point we need to meditate on the trauma of accounting, but no, that's another discussion. Um, I think that to that point, right, your ownership might go down, but our sliver in the pie has gotten bigger because our check got bigger. So, there's a lot of really interesting things here. And yes, we would love to be proactive, and we've definitely stepped up how we're showing up with our back office and operations. And so this is a lot of fun.
indeed.
Speaking of planning, let's talk about planning. I know tax planning is something that Ernie, you do a really good job of asking the questions and, thinking through, well, what do we need? What do we want to plan for? How do we make sure we're in a good position? Do you want to talk about tax planning a little bit, maybe timeline or thinking through liquidity events or write-offs or I don't know, any of this?
Sure. So the basics of tax planning, right, that most people are familiar with is that you have 4 quarters under which to do some planning and send some money to the government. Your cutoff, right, for being able to do something in any calendar year is January 15th of the year following the close, right? That's just the brass tacks around planning. The real planning that comes into play is the partnership giving you information, right? In exactly this format or others, right? Typically through really good financial statements that are timely. We refer to those as relevant and reliable, right? Good accounting went into it. So your planning, right, that you do on a personal level is only as good as the data that you receive from the partnership that you're participating in. And so you want to make sure that you're working with somebody who knows how to kind of facilitate a conversation like that. In our world, we use terms like prescriptive planning, which means we want to know the assumptions that you're making globally, right, around your taxes, your wealth, and your finances, and the drivers, right, that are going to help you get there. You have a new job, you started a new business, you made a new investment. What are the things that are coming at you? And specifically, are they coming at you in an immediate and measurable way? Like it's tomorrow. I just got an email from Natalie that there's going to be a big event. It's proactive. I got an email from Natalie saying good things are going on. This is getting really exciting. Stay tuned. Or strategic. You've just made the investment, right? So now you need to understand I've got this capital contribution and then this investment that I made. My planning needs are more balance sheet driven. Where are all of my investments as part of my planning goals? And also, who else is involved in that? You have Natalie sitting here today, you have myself, but who are your wealth managers, right? Private or people that you use in a more compliance-driven way, but who are the others that provide you guidance around planning?
And I want to bring up a concept which is really interesting. As private investors, right, we can be locked up in these deals for many years. And there can be events that literally require you to pay taxes where you don't receive liquidity and being aware of this kind of thing. So I'll give you an example. Maybe you exercise, options and now you hold a position in a company and you were like, oh, well, there's the option exercise, but do you know there might also be a taxable event in addition to the exercise? So, there's different things. Private equity firms, they might, basically have a non-cash situation where you owe some taxes. How thoughtful and how much planning is going into how events are taking place and how, let's say, the GPs or the managers of the partnership are navigating these things, because it really wouldn't be fun to be like, oh, you have some tax liability and you have no cash flow. And so just recognizing who you work with, who you invest with, this kind of stuff matters. And I had multiple liquidity events, or I should say, liquidity event is an interesting phrase. I had multiple M&A transactions happen last year in my portfolio, sometimes liquidity, sometimes cash, sometimes not. But being aware, is there going to be an event where I owe something? You really need to be on top of this stuff.
It, it's such a huge point, and I skimmed over it earlier. And the thing that most people don't realize early is that you could have reportable shares of income and gains regardless if cash has been distributed or not.
Yeah.
It doesn't matter. It happens to people all the time, and they just don't understand how that could possibly be the case. But these are called pass-through entities. They don't pay their own taxes. Everything makes its way over to the partner. So working with somebody who understands in a tax planning capacity, it doesn't mean this money has hit your checking account.
Right. All right, let's not scare them too much. We're just providing the info. No, I'm kidding. Okay, good. A non-smiling. So we're talking about these things, planning, being proactive, knowing these things, and we're not going to dig into something like qualified small business savings today. We're going to talk about it on a future, more strategic tax session. But what should we look for? We're investors. What do we need in an accounting partner? Because let me tell you, I've been there. If your accounting partner doesn't understand QSBS, that can be a big problem. So, Ernie, give us your take of, how should folks be navigating and stepping into agency with respect to who they're working with?
You mentioned earlier, Natalie, about productivity and application of tech and modern tools. And since COVID, things have really accelerated in terms of change in what people, it's not your mom's tax preparer anymore. Let's put it that way, right? The guy or the gal who showed up in your parents' kitchen with their laptop or their pen and pencil to do their taxes are the modern day haberdashery. They're not around. So you really are looking to primarily not work with historians. Historians, the role that they have played is generally speaking over. And modern technology, especially AI these days, is really raising the bar on minimum expectations, right? And who your accounting partner should be. And that is really best said the way I said earlier, somebody who can work with you to predict an outcome, to use quality data, to use what did occur in the past, and either predict or prescribe an outcome. That used to be that was alien to people who did just traditional tax preparation. A bunch of documents showed up on the desk and they did the best they could to interpret that data and minimize your tax expense as much as possible, which was not really easy to do, right? Because the die was cast. And these people, like the ones I'm referring to, the people who now do this better, who do leverage modern tools and have a more planning based or prescriptive approach, that doesn't translate into expensive. It makes it a little harder to find, but it doesn't necessarily mean it's expensive. And you can save yourself cost on the front end and throughout the whole experience by participating in events like this and becoming more aware, right, and having more information on a proactive basis. So the world has changed, but it hasn't gone away. Current providers today are very excited about where the world is as it relates to doing compliance-based tax prep, but now leveraging that into a more planning relationship or planning-based relationship.
Yeah, and gosh, I kind of want to ask for a show of hands on the AI stuff because we live in a whole new brave tech world today. But if you're not, jumping in, I mean, just what a shout out. I'm right now running granola. What a smarter way to, be able to analyze and say what actually happened in the meeting. Like, AI can be used in such great ways, but the human element of let's be strategic and have a framework and make sure, this thing's not lying to us, all of that matters. And so, yeah, technology, absolutely. Um, we got a nice question in the chat. Paulina had asked, when you do follow-on investments or reinvest in a company, are we creating a net new SPV or are we reinvesting or with the same SPV? An SPV, for anyone who's wondering, it means special purpose vehicle. We call it syndications when we create investment, group investment vehicles. Um, what I will say is an SPV or creating a net new SPV, each time is going to be really cost prohibitive. So unless you're investing, and by the way, Ernie is welcome to chime in and also correct me or amend what I'm saying, but unless you're investing a ton of money as a group, that would really scare me to create a net new one. So we are again restating with K1s our syndication when we do the follow-on. And again, we're creating syndications. We're not using an SPV vehicle. Just to give you a back of the envelope cost scenario, an SPV is typically going to cost like $8,000 to $10,000 or more, depending on how many investors and all these things. We've brought our cost down materially, where right now it's about $5,000. And we are really investor friendly. Frankly, it should be a little bit higher for how much we do, but um, when we're doing a follow-on, then we'll assess another small, like more nominal fee, not near 5,000, unless it's a bunch of investors and if we maybe underfunded up front. But the point is our cost and expense ratio are really investor friendly. So let me pause there.
I so Natalie, I really do agree with everything that you said. It does speak to this very advanced planning that you've done to keep these costs low, because unless you have a money is no object opportunity in front of you, right, a bottomless resource from which to throw, you could erode all tax efficiency through operational expense inefficiency.
Yeah.
And fees are at the partnership prep level, those are not low. Even
Well,
tools.
forget tax efficiency. You can erode any returns.
Oh, that's what I'm
You
saying.
know?
Any right,
Yeah.
absolutely. Right, thank
Yeah.
thank you. Right,
Yeah.
like all the upside can quickly be lost in operational expenses that are unnecessary.
Sure. Yeah. Love the questions. I know we've covered a lot, but let's dive into a few more things. Tax planning, thinking about, what are going to be the costs. Um, the topic of ordinary income versus capital gains income. That's a fun one because we're oftentimes investing, in things that are going to be over a year hold. So maybe speak to that briefly.
You know, the easiest thing about that, right, is the efficiency conversation. Capital gain income, by and large, is going to be a more tax efficient way for you to earn income. Specifically for one reason, it's not subject to Social Security and Medicare taxes. So having a really clear understanding of what's coming your way and the type of income that it is seriously impacts your planning. We're
Yeah.
also living in a historically favorable capital gain time in our lives. And so there are massive exclusions on capital gain income that a lot of people are just not even aware of. So resources are rich, readily available. Your basic internet search or AI search is going to yield some good info on how to distinguish between ordinary income and capital gain income and how to plan for it.
That's a preview for we'll dive in a lot more into efficiency and strategic concepts in a follow-up discussion with Ernie. We'll talk about, QSBS and 83Bs if you don't know what they are and you have equity, whatever, that'll be another discussion. But the point is, there's so much that you can think and be proactive around with regard to tax planning, and paying less in tax because, hey, if we can, why not? Then we have more to invest and more to enjoy. Um,
Agreed.
and I think in closing, just a big takeaway should be plan for the outcome that will optimize and maximize and, you know, don't just give money away or, be stuck in a cashless position where you owe taxes, make sure you're stepping into agency here and gain the wisdom and step into knowledge, ask questions. This is really important. And we've had a lot of folks in our group who've admitted, and I say this, with love, they've admitted, oh, well, I don't love the wealth manager I'm working with, or I don't trust, or they don't have my values, aligned, or they don't really know the strategy around private investing. Really important to talk about this stuff and to reimagine and, evolve the way that you are working with people that, show up in these realms, whether it be accounting or, wealth management, who is in your circle? Because at the end of the day, you're showing up and you're thinking about investing, or maybe you're actively investing. So we want to make sure that you're really resourced for that.
Definitely. Plan for your outcome. Don't let the moment K1 lands in your inbox be the moment where you start to develop an understanding of what this means to you.
Yeah, great.
The resources are far and wide and e easy to get your hands on.
We have a really good question in the chat. And Ernie, I'm going to let you decide if you want to answer it today or if we want to put it into the next session, which again is going to be Feb 18th. We'll have it on our Luma. Um, but the question is basically pros, cons of different types of partnerships. So investing as an individual versus an entity. So do we
Yes,
want to talk about that now or next time?
yes. And for the benefit of my malpractice provider, this is general information, not specific tax advice. So I have to be cautious not to back into an engagement unexpectedly with somebody on the call. So I apologize for those terms and conditions.
Don't apologize.
Not who I am. So really, one of the areas where we see people get stuck on this is when they have invested through a IRA, right, or another retirement plan or a trust, and not realizing where and when impact might occur or not occur. We've had a lot of people get really concerned about the circumstances or the results within their K1, only to look down and say, well, you have no planning opportunity because this is in your Roth IRA. So really being able to understand what umbrella you fall under, I think if I'm getting like what type of partnership, um, for the most part, people are individual investors. Even if they have created an LLC for a trust, most commonly those trusts are considered revocable, meaning they are in place for a future event, typically the passing of an individual, and in life, that information lands on their personal tax return. That's why really having these K1s in your possession as fast as possible to make sure everybody who helped you with your intentions is aware of the impact from those intentions, especially as it relates to your personal tax return. Because under an IRA, it's not going anywhere. It's going in a file, and you're going to preserve it for information later when you start distributing income, not from the investment, but from the IRA. And this opens up a wide conversation around self-directed and what you have to report to. There's great organizations like New Direction who help people manage their IRAs in investments that are not in readily marketable investment types or publicly traded partnerships. So I'm very happy to expand this conversation because there are lots of pros and lots of cons because there are lots of different types of partnerships. I hope if you want me to expand on it, we're really good on time. I'm happy to.
Well, we have a follow-up conversation that's going to be
Okay.
strategic too. So I think
Okay.
this was great. I mean, the fact that we still have most people on, and this was a conversation, again, talking about the beauty of taxes, that warms my heart.
Yes.
This was really fun. I'm hoping that it not only started to introduce topics more deeply, but that you really, get to start thinking more strategically. Am I, planning? Was I aware of some of these things? Do I need to reassess, what my situation looks like? And I love these questions. Anand, your question's great. Even me, I'm like, okay, I'm still investing as an individual. Do I want to have that investment LLC? So really, really great, thoughts and questions coming up. Maybe next week we can talk more about Dr. Edong just dropped a question about investing from an IRA, a Roth or otherwise, which I love
Great.
that. And some of our members at She's Independent are investing, via retirement accounts. And by the way, tax treatment, talk about growth in a Roth. Okay, we're just get excited. No, right? If you know, you know.
And taxes are beautiful, Tracy. We really nerd out on the beauty of it all.
We do.
Yeah.
And how great is that? So just quickly, let me state again, we're gonna have a follow-up conversation. We will put this live on our, or I should say, recording on our YouTube. If you're not a member at She's Independent, we did open this up to folks. You can ask questions. We'll send you the membership experience deck out of Luma just as a thanks for joining today. And we'd love to welcome more folks if it aligns. And I know Ernie would also welcome, a conversation or exploration if you want to work with him and his team. So we'll make sure all of this is available to you. And then I guess as a transition, and this is kind of a fun, I know I'm saying fun because Rachel is just going to start smiling and eat on because they're some of our primary deal leaders at She's Independent. We're actually going to end this recording and move into a little bit more of our deal call in preparation for our next pitch day, which you don't have to stay on, but if you want to, we invite you. And again, it's kind of a member experience discussion, but just wanted to give a little preview. So thank you again so much, Ernie. Thanks to everyone for joining. You're again welcome to stay on a little bit longer to talk about some of these deals we're looking at for our next pitch day, but I just wanted to bring some closure to the accounting discussion today.
Thank you, Natalie. I just gratitude is the only word that comes to mind to be part of a conversation like this. They are few and far between these days as people start using modern technology and communicating in more remote environments. It seems to be building silos around these kinds of topics,
Mm,
and
mm.
a rising tide floats all boats. I'm very pleased.
People are everything. And it's like technology only works if you're working in a construct, in a framework that you have agency in and, people that have knowledge and they're proactive to learn. And so we really appreciate you, Ernie. And
Same
again,
here.
y'all are welcome to stay on, but I'm going to stop the recording.
I have a tax planning meeting to jump to, so I'm gonna
Of
go put
course you do.
yes. Thank you all very
Enjoy.
much.
Bye.